Good afternoon, everyone. Welcome to this Get to Grips with Basic Bookkeeping webinar. I hope you're all having a lovely day so far. My name is Annie. I'm an education specialist here at Xero, and it's my pleasure to take you through this webinar this afternoon. Now, just before we get started, there's a couple of housekeeping bits that I wanted to take you through just to make sure you get the best out of the webinar. So it's always a good idea just to close down any other applications that might be running in the background. Things such as Skype, emails, other browsers, etc. Just because it can use up your bandwidth and cause the audio to be a bit jumpy. So if you can close those down, that would be great. You should see a webinar control panel coming up on the screen that will show you the different options for audio, raising your hand. So I might ask you to raise your hand throughout the session, the chat box, which will be disabled for yourselves, as I'll be using that to send some resources out to you. However, we do have the Q&A box where you're welcome to send any questions that you have through. So if you want to ask any questions, please feel free to pop them in there. So make sure you can see that control panel. If you can't, just give your mouse a wiggle on the screen and it should then be available. So if I could just ask you to find that Q&A box now and just pop a little smiley face in there, say hello, or just let me know where you're tuning in from. It's always nice to see where everyone's based, but it also does just let me know that the audio is working okay and I'm not going to be talking to myself for the next hour. Lovely, lots of smiley faces coming through, lots of hellos there, and lots of different locations there as well. That's great. Thank you very much, everyone. It's great to know that you can all hear me okay. So let's start off with the agenda then. So we're just going to be looking at the basics of bookkeeping. But what I would like to make really clear before we kick off is this webinar isn't to give any sort of accounting advice. So we're just here to help you with those processes. So we'll be looking at transactions with customers, transactions with suppliers. We'll take a look at chart of accounts, sales and purchases, and then we'll finish off with a look at reports and a slight nod to debits and credits. As I said, though, we're not here to give accounting advice. So I would definitely recommend reaching out to your accountant for any advice on that side of things, should you need it. If you do, however, have any questions around the content or that side of things, then please feel free to ask those in the Q&A box and we'll get those answered for you. So first of all, then, before we get going, I'm just going to send some links out to you in the chat panel. So if you just open that up now, there will be a link to a workbook for what we'll cover today. So it's got the slides and all the areas that we cover, so you can download and take those away. There's also some activities within the workbook that we'll be making some time to do during the webinar, and a glossary of accounting terms at the end to help you understand what some of the accounting lingo means. Now, when it comes to downloading that workbook, the link that I've sent you is going to take you through to a page called Box, and you can then download the workbook from there. When you click the download button, it does sometimes look as though it's asking you to log into Box, which you don't need to do. So just click that link. There will be a pop-up that says to either log in or sign up, but it will also say that your download is in progress. So just ignore the login option and you'll still be able to download that workbook anyway. The other link I've shared with you is a link for the activities. So leave that for now. And then when we get to that first activity very soon, I will take you through that then. But for those of you that might have clicked on it already, you'll see that it takes you through to Xero Central. So you're in the right place, but don't worry about that just yet. We'll come to that very shortly. Okay, so the first section today is having a look at the different types of transactions with customers and suppliers. Now, you may be thinking that you're already dealing with customers and suppliers, so you know what this process looks like. But there might be more steps to this process than you realize, and this process is different for every business. So we'll have a look at customer transactions first of all. And again, this is going to vary between different businesses, but your first transaction when you deal with a customer could be that you raise a quote for them. Now, a quote is prepared to send to a potential customer to allow that customer to see the cost of the product or services and terms of business before they commit to using a business. But it could be that your business doesn't need to use quotes, so a quote is not always necessary. So in this case, your first transaction would be an invoice. And an invoice is raised to request payment for a product or service provided to the customer. And the invoice may be raised at different times depending on the type of transaction that's happened. For example, if you have customers that come into your shop or your premises and they buy things from you face to face, in that case, you may well raise the invoice at the same time. So at that point in time, you might receive orders online or over the phone, in which case you may decide to raise the invoice as soon as you receive the order. Or it could be that you raise it a day or two later, once the order has been packed and is ready for delivery or collection. But maybe your business is going to be invoicing for time. So that could be hours, it could be days, weeks, or even months spent on a particular job. So in that case, you'll be unable to invoice before the job has started because you're unsure exactly how long that's going to take. So that's a really good use case for quotes. So you could raise a quote for the estimate of the job. And then when it comes to invoicing, depending on how big the job is, you may want to invoice at the very end. But if it is a bigger job, you might decide to invoice partway through to recoup some of those costs that you've had to spend. Next, you've got statements. Statements can be sent to customers on a regular basis. So usually a monthly basis of when they're sent out, or when the customer requests one. And there are two types of statements that you might come across. You've got an activity statement and an outstanding statement. So the activity statement is going to list out and show the customer all of the activity on their account with you for the duration of that statement. So that's going to be all invoices, all payments, and any credit notes that have been raised or paid from that customer. You've then got the outstanding statement. So the outstanding statement is going to show any outstanding transactions. So if there was an invoice that was raised within the date range of that statement, but it's also been paid off in full, then that won't show on the outstanding statement. It's just transactions that have either been part paid or haven't been paid at all. Next, you've got credit notes. And a credit note will be issued when the customer is returning items or no longer requires a service that's already been invoiced. So if a customer decides to return something that they've already been invoiced for, then you'd issue a credit note to them. So this is either going to reduce an existing invoice down to zero or reduce it down by a smaller amount. And then lastly, you've got your customer payments, which I'm sure is everyone's favorite part of this journey. So customers could decide to pay their invoices in just one payment, which is a nice, simple transaction, but that isn't always going to be the case. So it could be that customers decide to pay in installments. especially if they owe you quite a lot. It could be that they're going to be paying off multiple invoices in one go. So maybe they're paying off 2 or 3 invoices with just one transaction. And of course, when they make these payments to you, they could be cash, they could be card, bank transfer, it could be via some sort of online payment system, or it could be occasionally a check or a gift voucher or something else. So there's many different options there. So that is the customer journey from a transaction point of view. You've then got the supplier journey as well. And again, not all of these different types of transactions are going to be applicable to all types of business. The first is a purchase order. Now, just before I explain what this is, for those of you that might not know, if you could just raise your hand for me if your business does raise purchase orders for your suppliers. Okay, we've got a few hands going up there. I'd say maybe that's about 5%. So I'd say maybe 5% of you have said yes to that. So in this case, purchase orders are raised about 5% of the time. And they are sent over to a supplier to let them know of an order that you're placing with them. So this purchase order is going to list out the address of both yourself and your supplier, but more importantly, the items and quantities that you're ordering from them. And the purchase order can then be a really great document to check back with when you receive the order from the supplier in the future. Next, you've got bills. Now, you may refer to these as purchases or supplier invoices or purchase or supplier bills, or maybe something completely different. Now, the main thing that I wanted to just point out here is the choice of language. So we do try and keep the language between customers and suppliers as separate as we can. So a supplier purchase is just simply a bill within Xero, and a customer sale is just simply an invoice. So that's just simply bills and invoices within Xero. Next, you've got credit notes. So if you buy an item or a service from a supplier and you no longer need it, or you need to return it to them for whatever reason, they will issue a credit note to you. And again, that could reduce the amount of the bill down to 0, or just reduce it by a smaller amount, still leaving a balance to be paid. Next, there is a transaction or a document that again isn't always used, and that's the remittance advice. So could you just raise your hand for me again if your business does raise remittance advice for suppliers? Okay, that's maybe a few more this time, so maybe 10% that time. So a couple more raised their hand. So a remittance advice is sent over to a supplier to let them know that you've made a payment to them. Now, this is going to detail the bills that you've paid, the method and the amount of the payment. And from a supplier point of view, it's a really great document to tell them exactly what you've paid and when, so that they can locate that payment and allocate it to the correct bills. So it's particularly handy if you're paying multiple bills in one go. And then when it comes to those payments again, as with your customer payments, they could be just your one-off payments, they could be installments, they could be bulk payments. And again, you've got your cash, card, bank transfer, etc. So many different options. And then you've got expenses. Now with expenses, they can be split into 2 categories. So you've got reimbursable and non-reimbursable expenses. So a reimbursable expense, it can be a transaction of any value at all. but usually a reimbursable expense is lower in value. So with this type of transaction, it means that a member of staff within the business has bought something for the business. So some sort of business transaction. So it could be supplies, say coffee, tea, paper, or stationery, or it could be that they've had to travel for work and they've had to buy a train ticket or a taxi. So they've bought something for the business, but they've had to use their own money. So the business then needs to pay them back or reimburse them for that business transaction. A non-reimbursable expense, again, it can be a transaction of any value at all. But this time the staff member has used the business's money. So that could be business cash or a business bank card or a credit card, and they've used that to purchase the business expense. So the difference there is where the funds have actually come from to pay for that item initially. And then if it's personal, it of course then needs to be reimbursed. Now, before we move on too much further, it's important to understand some of the key differences between a limited company and a sole trade business. Now, there are many other types of business structure, but I do believe that these are the two most common, and I'm hoping to prove that theory with the help of all of you. So if the business that you are attending this webinar today on behalf of, if that business is either a sole trader or a limited company, could you please just raise your hand for me? Now, I'm hoping that we have lots of hands going up, which we do at the moment, which is great. And I can see a thumbs up in that Q&A as well. So I'd say that's probably about 60% of you. So that's quite a few of you have raised your hand for that, which is good. It does prove my theory. So thank you very much. So some other examples could be charities, trusts, limited liability companies, PLCs, so all sorts of different types of companies as well. And I'll just reiterate, if you do hear something within this webinar today that prompts you to think about changing business structure, I definitely recommend that you do have that conversation with your accountant or your bookkeeper before you go ahead and do that. So we're going to look at a sole trader business first of all. So with a sole trader, the business and the owner are classed as one entity. So this means that any profit or loss that is incurred by the sole trader business, that belongs to the business owner. So that profit or that loss figure is then going to appear on the tax return, the personal tax return of that business owner. And they will then pay their own taxes on those business profits. The assets and liabilities, they also belong to the business owner. So that means that if there is a loan within the business, that if the sole trader were to miss or they are late with the payments towards that loan company is then going to chase the sole trader for that personally, as they are classed as the same thing. Now, if a sole trader were to use any business money to pay for something that is a personal and unrelated to the business, then that is posted to what's called a drawings account. And the drawings account is an ongoing running balance of any amounts owed between the business and the business owner. So that's a sole trader. With a limited company, as you can see straight away, there are a lot more rules around how this type of business works. So with a limited company, the business and the owner are classed as separate entities. So there could be multiple owners, and these owners are called shareholders. And those shareholders that are running the business are classed as directors. And the profit or loss that is incurred by a limited company, that belongs to the company itself. And the company is then going to pay corporation tax on those business profits. Now, if a company director chose to take any money out of the business, it would need to be in a much more structured manner than that of a sole trader. So this could it could be via an official salary being taken through a payroll scheme, or by dividends being voted. And I'll come on to dividends in just a moment. So if a director chose to take any other money out of the business that wasn't through either a payroll scheme or a dividend, then it's posted to what's called their DLA, which is their director's loan account. And that really is as it says in the name. So it's a loan to the directors, and as it's a loan, it will need repaying back to the business. So just coming back to dividends, and to decide if you can vote dividends, you need to have a look at the retained earnings account. So retained earnings are the total sum of all business profit and losses, less any dividends since the business first started. And dividends can then be voted if there is a positive balance sitting within the retained earnings account. So for example, let's say a limited company has a retained earnings balance of £10,000. And in the current year, they make a £5,000 profit. So they then got £15,000 sitting in their retained earnings account. So dividends can then be voted of £15,000, reducing that right back down to zero. Or you might decide to vote dividends of, say, £10,000, leaving £5,000 in the retained earnings account. And that remaining amount of £5,000 will then roll forward to the next year, where it will be added to the profits from that year. You'd have a new balance where you can then vote dividends of a different amount, and that will then roll forward forevermore until the limited company closes. So they are some of just those key differences between those two types of business. Now, before we get to our first activity, we're going to have a very quick look through the chart of accounts. Now, you'll find that your transactions are posted to different account codes, and this is going to allow you to see where the business is making and spending its money. And these account codes are split into 5 different categories. So within your assets, in here, you'll see things that the business owns. So that could be any vehicles. The bank account would sit within this area. Stock that you're waiting to sell, but also any money owed to the business by its customers. And they're also known as receivables. You've then got your liabilities, which are essentially the opposite to assets. So money the business owes, and that could be loans. It could be the overdrawn bank account if it is overdrawn. There could be a tax bill that's due for payment, but also it might be that your business has bills that you need to pay. So supplier bills that are unpaid at the moment, which are also known as payables. Equity or capital is where you'll find the money invested into the business. So this could be money that was invested when the business first started, but it could also be any money that maybe you've had to add into the business just to help keep it afloat. You've then got income. So this is the money earned by the business. That could be income from sales, but also income from any other sources. So maybe the business has a bank account and it receives interest. So that interest is another form of revenue or income. And lastly, you have expenses. So these are the costs to the business. So it might be that the business has had to buy material to make and sell items, but also any of the overheads. So things like your wages, utility bills, insurance, and those general day-to-day running costs. They'll all be found in expenses. Okay, so that now brings us to our first activity. So what I'll do, I'll just reshare the activity link in the chat panel, just in case anybody arrived after I shared that link the first time round. So if you bear with me just 1 second, you should see that coming through to you now. Okay, so once you click on that activities link, it should take you through to a login page. So if you haven't done already, the first thing you'll need to do is log in. And you'll just need to use your usual Xero login details for that. So I've already logged in, which is why it's taken me through to this activity page that you can see here. So once you've logged in, you'll land on this page just here. And we're going to be coming back to these throughout the next half an hour or so. So click into that link in the chat panel. It may take a few moments to load, but it should get there eventually. And then you just want to scroll past the introduction, where you can find activity 1 and question 1. So we're only doing this one question for now, and then we'll come back to the others later on. So here you've got the 5 chart of account categories. And what you need to do here is just pick up the different types of transactions and drag and drop them against what you think is the correct chart of account category. So then once you've done that for all 8 of them, you can scroll down and just hit submit just there. And then you'll find out if you've got that question right or wrong. If you do get it wrong, firstly, please don't panic. It's just a bit of fun. Secondly, you can click resubmit and do it as many times as you want. So I'm going to give you slightly longer for this one, as it is our first activity. So we'll take 5 minutes for this one, and then we'll take 3 minutes for the other activities a bit later on. So what I'm going to do, I'm going to mute myself for 5 minutes. So then I'll come back. We're at 28 minutes past now. So we'll come back at 33 minutes past with the answers. And I'll leave this on my screen. So if you do struggle to find it yourself, then you can, of course, just have a look at the screen here, and then feel free to send the answers to me in the Q&A panel if you want to. And then we'll go over the answers when the 5 minutes is up. So as I said, I'll come back at 33 minutes past with the answers. So good luck and enjoy that question. Hey, so that brings us to the end of that activity. So the answers for those of you that maybe got a bit stuck, or maybe you were just working through it on my screen. The laptop is something the business owns, so it's classed as an asset. Your sales are revenue or income. Unpaid supply bills are classed as liabilities. Money that you've invested into the business is capital. The loan is something the business owes to external parties, so that is also a liability. The insurance and the rent payments, they are both classed as expenses. And then lastly, interest received is another form of revenue or income. So well done to those of you that managed to get that question correct. So next, we're going to have a look at sales and how you can categorize them. Now, all sales can be categorized into one or two pots, and they are cash or credit. Now, firstly, your cash sales are any sales that you make where payment is received immediately. So when I say a cash sale, I don't mean that the customer has paid you with cash. So they could have used cash or notes or coins, but they could have used any other type of payment method where they've paid straight away. So that could be by debit or credit card. It could be bank transfer, or it could be via a check. Now, of course, with a check payment, the customer is going to give you that check, and you then need to pay that in and wait for it to clear. But from the customer point of view, there's nothing else for them to do as they've settled their debt with you. So it's just a case of waiting for that to clear. The other type of sale could be a credit sale. So this is when somebody is going to buy something from you and they'll then pay in the future. So there'll be a plan in place for them to pay for that purchase in the future. So they'll usually have some sort of agreement in place where you've said they'll be able to buy some items or services from you up to a certain value with a plan to pay for those transactions in the future. So that plan would usually involve a payment date. So it could be the end of the month, and they're able to buy items up to a certain value. And that's a really good use case for, firstly, a statement to tell them exactly what they owe you. But also when they do then make that payment, they can send over a remittance advice to let you know what they've paid and how they've paid for it. Now, when it comes to your purchases, these can also be split into those two categories, cash and credit. But with these, you just reverse that situation. So you are now the customer, and think about how you deal with your suppliers. Do you tend to pay for things straight away, making them cash purchases, or do you pay for them a little bit later on, maybe a few weeks down the line? So that brings us on to our next activity, which I think is quite a nice one. So if we go back to our activities page, we're just going to scroll past that one to activity 2, where you can find question 1. So here you have 4 scenarios. So you need to read the scenario and then decide if you think that it's a cash or credit, sale or purchase. So I'll give you 3 minutes for this one, as hopefully you've all found the activity page already. But if you do struggle, please do just either read it on my screen, and if you'd like to, you can use the Q&A to send those answers across to me. So I'm just going to mute myself again. So we've just passed, so it's 22 minutes to at the moment. So if we come back at 14:41, so I'll just mute myself again and then come back at 14:41 with the answers. So again, good luck and enjoy those questions. Okay, that brings us to the end of that activity. So I'll go through the answers with you once again. And these are just from top to bottom. So the first scenario was a cash sale. The second was a credit purchase. Third was a credit sale. And the last one was a cash purchase. So again, well done if you did manage to get that correct. So we're going to have a look next at reporting. And there are many reports that you'll be able to use in Xero. And they'll give you different information depending on what you're looking at and how you edit the report. But we've got two reports that are key. The first is the profit and loss. And this is going to show you how the business is performing in a certain period. So it takes into account all of the income and your expenditure, and it will summarize those details to give you either a profit or a loss figure for the period. And it can be a great report to check in with on a regular basis to see how the business is doing. But please do bear in mind that this will only reflect the transactions that you've recorded in Xero. Now, it starts with your revenue at the top. So this is where you'll see the sales for products or services that you've made, but also any money earned on any investments. Next, you have cost of sales. So this is where it can get slightly confusing. So the cost of sales are the direct costs that your business incurs in order to make the sale. And these will be different for all businesses. So let's say, for example, I have a business that makes and sells tables and chairs. That means that my direct costs or cost of sales are going to be my materials, which would be the timber, but also the nuts and the bolts or the adhesives that I'm using to put these tables and chairs together. It would also be the labour of the team that are working to build these tables and chairs. So they would be my cost of sales. You've then got your gross profit. So this is calculated as your total revenue minus your cost of sales. So this figure here doesn't take into account your overheads. Next, you have expenses. So in here, you'll find all of the other business costs, and they don't link directly to trading. So for example, if you need to rent a space, so it could be an office, a unit, a factory, or anything else, it'd be things like your rent, your service charge, your utility bills, any insurance, all of that is classed as your overheads. Now, a really good way of looking at these, a term that's used that I think actually is really helpful to explain them, is that these are your operating expenses. So that means that in order for your business to operate, it needs to incur these expenses, but they don't link directly to the day-to-day trading that your business does. And lastly, you've got net profit at the bottom. So this is your gross profit minus your expenses to give you your net profit amount. So that is the profit and loss. The other really key report that I mentioned is the balance sheet. So this takes into account all of the assets and liabilities, and it will give you the business's financial position at a selected date. Now, you'll see here that a lot of these account codes are classed as current or non-current. And there is a 12-month rule to decide whether something is current or non-current. And that 12-month rule says that if something can be either converted to cash, or it can have the cash value realized in under 12 months, it's a current asset or liability. If it's going to take more than 12 months, to either convert or realize the cash value, then it's a non-current transaction. Now, hopefully that's going to make more sense when I go through them now. So non-current assets, first of all, these are the assets that the business is going to use for an extended period. So this is going to be things such as the fixed assets. And that will be vehicles, machinery, computers, or office equipment, things you buy that usually cost quite a lot of money and you expect them to last for quite some time. So you see them probably as an investment. You've then got current assets. So these can be converted to cash in less than 12 months. So think about here things such as your receivables. So those customers that owe you money that you're, of course, waiting to receive. But also your stock that you're hoping to sell quite quickly. Your bank is another example because you could just withdraw the cash in the bank and then you've got that cash available. Current liabilities. These are the short-term liabilities. So in here, think about things such as the payables. So those suppliers that your business owes money to. Tax bills would be another one. Or it might also be that you have a bank, but your bank balance is overdrawn and you're looking to pay that off quite soon. Next, you've got non-current liabilities. So in here, you'll find things like loans or hire purchase agreements where you've usually got quite a few years left until those transactions are completely paid off. And lastly, equity or capital. Now, in this area, you would find the profits or the retained earnings of the business. And this area will very, very rarely, if ever at all, be used by you. So on the odd occasion that this group of accounts are used, it would be by the accountant or the bookkeeper. Okay, so that brings us on to our next activity. So we're going to head back over to our activity page. And then we're just going to scroll down to activity 3. And again, we have question 1. So this might look quite familiar here. So you've got your profit and loss, but it's been put into the incorrect order. So what you need to do here is just pick up the different categories and just drag and drop them into the correct order. So again, I'll give you 3 minutes and you're more than welcome to put the answers into the Q&A box again if you want to. So it's 11 minutes to 3 at the moment. So we'll come back at 14:52 with those answers. So I'll come back at 14:52 with the answers. So good luck and I hope you enjoy again. Welcome back, everybody. That brings us to the end of our final activity of the webinar today. So the correct order for the profit and loss, it should start with sales at the very top. After that, you'll have the cost of sales or cost of goods sold, which are your direct costs of the business. Next, you'll have gross profit, followed by the overheads or the expenses, and then your net profit at the bottom. So well done again if you managed to get that question correct. Now, you might have noticed when going through those two reports, they come back really nicely to the chart of accounts. And what you'll find is that there's never any crossover between the two. So on the left-hand side, you've got your profit and loss. And on the right-hand side, you have your balance sheet. So you'd never expect to find a profit and loss code on the balance sheet or a balance sheet code on the profit and loss. But saying that, there is one report that brings all of this together, and that is the trial balance. So the trial balance is another really key report, but that is really just simply the profit and loss and the balance sheet on the same report. Now, for our final section of the day, it's to have a look at what happens when you post your transactions. So when transactions do happen, they'll have different effects on the report, depending on, firstly, the type of transaction that you're posting, but also the account code that you've chosen to use. Now, you may well have heard of double entry and using debits and credits. So this involves posting to at least 2 account codes for you to correctly post a transaction into your accounting records. And those transactions, those 2 postings, are going to be made up of balancing debit and credit amounts. So say you need to post 100 as a debit, you might post, you must post transactions that total 100 as credits in order for that to balance. And then if your business is registered for VAT or sales tax, depending on your region, then it brings another element into that as well. So in that case, there would be at least 3 postings because you'd need to split out the VAT element and post that elsewhere as well. Now, if that sounds confusing, please don't panic, because the good news is that you don't need to understand how the double entry works. And that is good, I can assure you, because it can take a while to fully get your head around it. And the reason you don't need to know that is because Xero is going to do that work for you. So when you post a transaction into Xero, it's going to do the background double entry for you. So that means as long as you add all of your accounting data, so your bills, your invoices, and you reconcile the bank account, then Xero is going to do that background work for you and keep your accounts up to date without you even realizing that it's doing so. Now, just to finish off, there's a couple of things that I wanted to cover with you. The first is there is a final activity, but I'll leave you to do that in your own time. So if you head back over to the activity page, and then if you scroll down, you'll find activity 4, which is a quiz. So here there are 5 questions which cover everything that we've gone through during the webinar today. So that's up to you. You can do that in your own time if you wish. And then at the very bottom, so right at the bottom down here, you'll find Xero small business guides. Now, these are guides on all sorts of different things around running a business. So it's not just the accounting side of things. You can see there you've got things like running it online, financing, hiring staff, and so on. So all sorts of different stuff you can pick up from here if you'd like to. Okay, so what I'll also do now, I'll just reshare the workbook in case you want to keep that and download that yourselves. So you should see that coming through now. There's also a link there to our small business guides, just in case you haven't found that on the activities page. And I've also shared a survey link. So this survey is very short. We'd just love to hear what you thought of the webinar today. So if you thought it was useful, or maybe you didn't think it was high level enough, or maybe too detailed, whatever you think, please just let us know so that we can adjust our content and make it as valuable as possible. Now, we will hang around and answer any questions that you might have. So we've still got a couple of minutes left before we hit 3 o'clock. So please do send them across. But if you are looking to leave us at this point, a very big thank you for coming along. I really hope that it's been a useful hour out of your day and that you've picked up a thing or two. So again, if you are looking to join us now, thank you very much. And I hope you enjoy the rest of your day.